In a world that feels like it's constantly spinning out of control, how do the biggest companies actually survive? Well, the answer is something called enterprise risk management. You can think of it as the ultimate survival guide for business. And honestly, it's a critical skill for your future career. So let's dive in.
So let's kick things off with a really big idea. You know, when giants like Silicon Valley Bank or Credit Suisse collapsed, it wasn't because they got blindsided by some mystery event that came out of nowhere. No way. The risks were all right there, sitting on their books. And this quote just nails it. The real breakdown was a failure to see how all those little pieces of risk connected to each other. It was a failure of the big picture, a failure of governance, and maybe most importantly, a failure of the company culture itself. Okay, so here's the game plan for making sense of all this. First, we're going to look at why these giants fall in the first place. Then, we'll get into the frankly terrifying new speed of risk in our digital world. After that, we'll build out a modern playbook to actually fight back. And you'll see it's about a lot more than just numbers. It's about people. And finally, we'll see how this all shifts the goal from just managing risk to building true resilience. And I'll show you why that's basically a superpower for your career.
All right, let's jump right into Section 1. When giants fall, we're going to see why the old rulebook for managing risk isn't just a little outdated, it is completely, totally broken. This right here perfectly shows you the shift. On the left, you've got the old way of doing things. It was defensive, it was reactive, each department kind of did its own thing, and the whole process was slow. It was basically a box-ticking exercise to keep the regulators off your back. But now, look at the right. Modern risk management is strategic, it's proactive, it's connected across the entire company, and it has to be fast and dynamic. Risk has moved from some dusty back office right into the C-suite.
And this is the new reality in action. Those recent collapses weren't about one single thing going wrong. It was a domino effect. One risk, say market risk, like interest rates going up and hammering your bond portfolio, well, that can trigger a cascade. Suddenly you have a liquidity crisis, meaning you can't pay your bills. And then, almost instantly, a massive reputational disaster. And what lit the fuse? Things like having way too many of your customers from the same industry, and of course, the viral panic that can spread like wildfire on social media. It's all interconnected, and it's all dangerously fast.
And that speed brings us directly to our second section, the new speed of risk. Because, the most important variable today isn't just how big the impact of a risk is, it's how incredibly fast it can hit you.
For decades, this is pretty much how every company looked at risk. It's a simple 2D heat map. On one side, you've got likelihood, how likely is this to happen? And on the other, you've got impact. How bad is it going to be if it does? And look, this was fine when you were worried about slow-moving things, like a gradual change in the economy.
But that old map is missing the secret ingredient of modern chaos, velocity. This is the third dimension, and it's a total game changer. It's the speed of onset. How quickly a risk can go from being a tiny blip on the radar to a full-blown catastrophe. We're not talking months or years anymore. We're talking hours.
And here's the perfect and honestly kind of terrifying example of velocity in action. A classic bank run used to mean people physically lining up outside a bank for days. But a digital bank run, that's fueled by a few viral rumors on social media and the fact that everyone can pull out their money with a few taps on their phone. A bank can be drained of billions of dollars in a single afternoon. That is high-velocity risk, and it changes absolutely everything.
Okay, so things are fast, they're interconnected, and they're scary. So what do we do about it? Well, we aren't helpless. Let's get into our third section, a modern risk playbook. These are the actual tools professionals use to see, measure, and model the threats we're facing today. It all has to start with language. You got to speak the same language. A risk taxonomy is really just a common dictionary for all the risks a company faces. So, is a data breach a cyber risk or an operational risk? You know what? It doesn't really matter, as long as everyone in the company agrees on the same definition. Without that shared system, there's no way to connect the dots.
Okay, now for some of the numbers. For a long time, one of the key tools was value at risk, or VAR. It basically answers the question, on a normal bad day, what's the absolute most we could lose? The problem is it totally ignores the truly catastrophic days, what they call tail events. And that's why today, most people prefer expected shortfall. It asks a much smarter and much scarier question. Okay, let's say we do have one of those catastrophic days. What's our average loss going to look like? It forces you to stare right into the abyss.
So how do you even begin to calculate those kinds of potential losses? Well, one of the most powerful tools out there is a Monte Carlo simulation. I know, it sounds really intimidating, but the idea is actually pretty simple. First, you identify all the key variables that affect your business, stuff like interest rates, stock prices, whatever. Second, use a powerful computer to generate thousands or even millions of possible futures by just randomly tweaking those variables. And third, you analyze the whole range of outcomes. It gives you this incredible picture of not just what's likely, but what's possible, especially in those worst-case scenarios.
But here's the thing. You can have all the models and all the math in the world, and it won't save you if you ignore the single most important factor. And that brings us to Section 4, people, not just numbers. Because at the end of the day, your ultimate defense isn't a spreadsheet. It's your company culture.
This quote just says it all, doesn't it? If people in your company are afraid to speak up, if bad news always gets buried, if chasing the next quarterly profit is the only thing that matters, then all those fancy risk models are completely worthless. Culture really does eat strategy for breakfast.
So how do you actually build a good culture? Well, a classic way to think about it is this 3 lines of defense model. Think of it like this. The first line are the doers. These are the business units, the people on the front lines who have to own and manage their own risks every day. The second line are the challengers. That's your risk and compliance departments. They set the rules and keep an eye on the doers. And finally, the third line are the watchers. This is internal audit, and their job is to independently check if the first 2 lines are actually doing their jobs right. See, everyone has a role to play.
And this is what that kind of healthy culture really looks like in the wild. It's a place where employees feel safe enough to actually report bad news. It's where executive bonuses aren't just about this year's numbers, but about long-term results that account for risk. And maybe most importantly, it's a place where the chief risk officer can walk into the CEO's office and challenge them without getting fired. These are real, tangible things you should be looking for in any company you might work for one day.
Okay, let's bring it all home. Our final section, from risk to resilience. This is where we get into why all of this stuff should really matter to you, both personally and in your career.
So the single most important takeaway here is this. The whole goal of risk management has changed. The old goal was to try and prevent every single bad thing from happening. But let's be real, that's impossible. The new goal is to build an organization that is so strong, so agile, so resilient that it can survive and maybe even thrive through anything the world decides to throw at it.
Now, you might be thinking, wow, this all sounds really expensive. And you're not wrong. But the return on that investment in good ERM is massive. It's not just about avoiding big losses from fines or failures. It actually creates value. You get more efficient with your capital, which frees up cash for growth. And you get lower funding costs because banks and investors see you as a safer bet. Good ERM is not a cost center. It's a value creator.
And this is why this is so critical for you. When you're out there, interviewing for jobs, trying to figure out where to build your career, understanding how a company approaches risk is like having a secret weapon. It helps you tell the difference between a business that's truly strong, one that's built to last, and one that's just been riding a wave of good luck. And you definitely want to join the one that's prepared.
So, I'll leave you with this question to chew on. When you land that first job and you're sitting in those meetings, look around. Listen to how people talk. How will you be able to tell if your company is truly prepared for the chaos, or if it's just a house of cards hoping for the best? Thanks for watching.